Uh, Good afternoon, friends. Namaste. My name is Chandrasekhar. I'm economic advisor to the IMC Chamber of Commerce and Industry. IMC and MCX, and as we all know, MCX is India's largest commodity derivatives exchange. IMC and MCX have a long relationship, and we do these commodity derivative events regularly. And we cover a host of commodities, including energy products, bullion, base metals, agriculture, etc. And this is a part of an ongoing series of events which we call Commodity Fundamental Forum. For we will here be discussing the fundamentals. We are not discussing price outlook. I think we have to be very clear about the fact that we are not discussing price outlook, but market outlook, how the market is going to behave, what are the drivers of the market, what are the dynamics of the market, etc. Therefore, it's such a delight for me to welcome each one of the participants. It's a delight for me to welcome each one of my panelists. We have the one and only, the mover and shaker of the bullion market, Surendra Bhai Mehta from IBJA. And of course, we have Vikram Dhawan, who's, what should I say, who's actually Eid Ka Chand, can't catch him so easily. And of course, from MCX, we have the ever-smiling Shivanshu, who has joined. And he's the one who's actually, he's taken the bullion market to a certain level in this country. So without much ado, let's start. But I have some 2 or 3 mandatory slides to show. Anita, will you go to the first slide? But even before that, let me talk about the IMC Chamber of Commerce and Industry. This chamber is a 116-year-old chamber. Fantastic track record. This chamber has contributed to India's economic growth phenomenally. This chamber is very active in providing policy inputs for the government of India, and of course for the state government also. Here, the government of Maharashtra. We have several expert committees that actually work on creating policy inputs. But most important, from a commodity point of view, IMC is a SEBI accredited training institution for commodity derivatives. And IMC is the only chamber of commerce in India amongst probably 100 chambers of commerce. We are the only chamber of commerce with SEBI accreditation, and that makes all of us quite proud. It's a great distinction. Therefore, with this talk about IMC, IMC also has a youth wing, a ladies wing, several expert committees, a fantastic infrastructure, modern infrastructure, etc. And therefore, with this, let me request Anita to show the first slide of mandated by SEBI. Yes. We are in the World Investor Week 2023, October 9 to October 15th. And the theme for this year is a smart investor is cautious of unsolicited investment offered through social media. Investors have to be very, very cautious. There are always fraudsters around in the market trying to lure innocent investors. Therefore, you've got to be extraordinarily careful. You should know who you are dealing with. You should know whose advice you ought to take and whose advice you ought to avoid. Therefore, this is the theme for the Investor Week this year, 2023. Next. The next one, I would encourage each one of the participants to visit this investor.sebi.gov.in. This is a fantastic website of the SEBI. This is a new investor website which gives you a lot of information relating to personal finance, investment, financial calculation, calculator tab, etc., etc. This is again another great initiative by SEBI. And the next one, the third one, is a disclaimer. Obviously, both IMC and MCX issue this disclaimer. We are doing our best to create awareness, educate stakeholders in the value chain, and therefore there is a disclaimer from both IMC and MCX. There is a personal disclaimer from me, I Chandrasekhar, I'm not a trader. I do not hold any trading position either in the physical market or in the derivatives market, in commodities. I'm a student of the market, and in that capacity, I study and I research various commodities, including bullion. And for whatever I say is from the perspective of a student of this market. So with this, let me start. Let me start speaking about the theme for today, which is the Commodity Fundamentals Forum, and we are going to be discussing bullion. Okay. Now, first, all of us know very, very clearly that India is among the world's largest importers and consumers of gold. This is something which is common knowledge. Yet, despite being among the world's largest importers and consumers, we are not price setters. We are actually price takers. For me, it's actually it's very sad. We should have what I would call in a local lingo some dadagiri in the global market. But I think over a period of time, in the next few years, I'm sure we will have enough clout in the marketplace even to set prices. Gold prices are actually set in London and in New York markets. And our market, our domestic market, very largely follows the global trend. And therefore, because we largely follow the global trend, it is important for all the market participants and investors and potential market participants to understand the drivers and dynamics of the global bullion market. So this is the first proposition I want to make. Now, when I've been tracking this market for probably 25 years and a little more, what I found this year, 2023, I found a couple of myths have been busted by the behavior of gold as a commodity. And what is this myth? Number one, gold prices rise during geopolitical uncertainty is a firm conviction among people. Okay. But despite the ongoing Russia-Ukraine conflict, gold prices this year have actually declined. Okay. And when the Israel-Hamas conflict started 3 years ago, gold, of course, got a little bounce from its very, very low levels, so closer to 1800 or 1820. But we are unclear whether it's going to sustain. Therefore, geopolitical conflicts and concerns and instabilities are perhaps being discounted by the marketplace. So this is something all of us, this has left me quite surprised, number one. Number two, we also always assume gold is a great hedge against inflation. Yes, if you look historically, 100 years, gold prices and inflation have moved in tandem. Therefore, it is seen as a hedge against inflation. Yet, the whole of 23, inflation has been very, very high. And yet, gold prices have actually fallen. Okay, and therefore, this is again for me is a myth which has been burst by the behavior of the gold market. Gold prices have actually fallen from above $1,900 a troy ounce to by at least $100, closer to $1,800. Therefore, the relationship between geopolitics and gold price, the relationship between inflation and gold price, this is snapped. This is snapped this year. And therefore, what is important is this snapping of the relationship has also happened many times in the past, say, 2 decades or so. So we, as investors, you have to recognize that there has been a correlation between geopolitics and gold price, between inflation and gold price, but there is no causation. Correlation is different from causation, and this correlation can snap anytime depending on various other factors, and which is what we found this year. Now, we need to understand the current underlying drivers of the world gold market. Now, events in the US, I find are absolutely very critical or key determinants of gold price movement. One is, of course, US growth is very strong. The first half 2023 GDP growth in the US is much better than expected. The private consumption in the US is robust. Labor market is healthy. The world was talking about hard landing by the US economy. No, I think we moved out of it. Everybody is now talking about soft landing, which is what is expected. And US facing very high levels of inflation. Therefore, we have seen steady increase in the interest rate by the US Federal Reserve. And now they are talking about the position that US interest rates are expected to stay higher for longer. For we are not going to be able to get relief from high interest rate anytime soon. And similarly, the dollar has very surprisingly performed, not surprisingly, really, less surprisingly performed extremely well. It's quite strong. And the dollar is likely to remain stronger for longer. Inflation higher for longer, dollar stronger for longer. And we all know the inverse correlation between the US dollar and gold prices. Similarly, US bond yields have also been rising. But most critical in my view, and I I I feel, and in my interactions, I've found many of the analysts are they don't give enough weight to the physical market and physical demand. In fact, for me, physical demand is absolutely critical. It's a critical driver of gold prices. Look at China, look at India. Physical demand in major importing countries like China and India is quite muted. And even central bank purchases. Last year, gold had a big jump primarily because of huge purchases by central bank. And therefore, these are also drivers which we need to track, which is very important. And therefore, let me say, physical demand is weak. Chinese economy is slowing. China's GDP for 2023 was projected to be 5.5%, but it can possibly end below 5%. It could be probably around 4.8% or so. In India, agriculture, rural incomes are big drivers of gold consumption, but our own agriculture sector is facing challenges because of erratic monsoon and possibly lower kharif crops, whether it is coarse grains or rice or pulses or oil seeds, and even sugar for that matter. And therefore, rural incomes, because they are not likely to rise rapidly, it can actually hurt gold demand, because 60% of jewelry demand in India is from the rural areas. Okay, and therefore inflation, in addition, is burning a hole in the pockets of people. Now, therefore, all that I must say is gold is facing headwinds. What are these headwinds? Multiple headwinds, in fact. Strong dollar, rising bond yields, weak physical demand. And that's the reason why gold prices have fallen, gold rates have fallen very sharply towards $1,800 from about 1,900 plus dollars. It's fallen up to about 1,820. It just kind of recovered in the last 3 days, primarily because of the Israel-Hamas conflict of the last 3 days. But I find even this response by the gold market to this conflict is quite muted. Okay, and therefore gold is kind of staying back at its own level and not jumping much higher because of political or geopolitical conflict. But more important for me, for the first time in the last 1 year, in the last 12 months, I find speculative financial investors have actually created net short position in the both, not in India, of course, in the US. And that's a signal with respect to their mindset, what is their expectation. Therefore, the point is, what will gold continue to be a laggard, or what can change, what can give a fillip to gold prices? Let's jump to 2024. Okay, because we are in the last quarter of 23. For it's only appropriate to look at 24 and see, crystal gaze how gold is likely to behave. My own expectation is that in the US, interest rates have been rising, but usually the effect of the hike in interest rate has a lagged effect on the economy. And therefore, the lagged effect of the interest rate hike, in my view, will be felt in the first quarter of 24, or certainly in the second quarter of 2024 in the US, which is very important. And that is a time the US economy will start slowing. And that is a time the Federal Reserve may consider a rate cut. Today, rate cut is unthinkable, really speaking. Not in this quarter anyway, but next year, possibly in the latter half of first quarter, or sure, maybe in the early second quarter, there will be conditions which will create there will be conditions that will spur the Federal Reserve to actually consider rate cut, which obviously that decision will be data driven. It's that point of time when I am sure, and all of us will agree, that the dollar will start to weaken and gold will actually get a boost. For it's still, in my view, at least 4 to 6 months away. It's very, very difficult to time this market, and I'm not a great strategist to time this market. But on current reckoning, my own feeling is that this yellow metal will continue to languish at below $1,900 for the next 3 or 4 months or so. And in Q1, as new data start to flow in the US, I think the market may turn from bearish to volatile. This is a kind of market outlook for gold that I'm able to visualize. But we have those with hands-on experience in this market. We have, of course, Surendra Bhai, we have Vikram with us. They'll all tell us a lot more about this market than I have mentioned. But I have a request from our friends, Shivanshu from MCX. I suspect he has to leave for another meeting. Therefore, with Surendra Bhai's permission and Vikram's permission, I'll invite Shivanshu to share his thoughts with the market participants. Over to you, Shivanshu.
Thank you so much, Chandrasekharji. I hope I'm audible now.
Yeah, perfect.
And visible. Thank you so much. And my eminent co-panelists, of course, first the August House of the Indian Merchant Chambers, Professor G. Chandrasekharji, our Surendra Bhai Mehta, National President from IBJA, and the very seasoned, my dear friend, the very seasoned person from the Bullion fraternity, Mr. Vikram Dhawan, and all present here in this August gathering. I welcome you all on behalf of MCX. And I think I can't paraphrase enough, the asset class, as Mr. Chandrasekhar has already highlighted before you, whether it's a hedge against inflation, a hedge against geopolitical turmoil, a portfolio diversifier, a store of value, or in fact, a quasi-currency, whatever one may call it, but bullion as such and gold form a very important aspect of one's investment portfolio as a retail investor. Of course, the macroeconomic fundamentals play a very important role in the way that this asset class has performed or behaved. But from the very recent memory, one can always point out that during the COVID era, from March 2000 to September, which is just about a 6-month period, both gold as well as silver doubled in prices. And of course, there are various fundamental factors at play globally. But having said that, if you look at the theme in the domestic bullion and jewelry sector, if we cut to India, the theme very clearly has been that the government is focused upon organizing this sector, getting it completely above board, and actually creating an industry, so to speak. Not just a chain of outlets, industry of refining, industry of bullion trade, and an industry in terms of the jewelry fraternity. We have seen the organized jewelers perform more and more in this ensuing period. We've seen the onset of hallmarking across the country, which was made mandatory by the BIS. We have seen before that the advent of GST, and very recently the applicability of the PMLA on this sector, which of course has to do with the India signing the FATF, being a signatory to the FATF. So looking at all this, of course, we also saw the birth of the IIBX, which is one of our projects, as you know, in terms of it's a project of national importance. It's an Indian gold spot exchange, which in a country like India, which is arguably the first or the second largest consumer of gold globally year on year, is a very important institution to build. And we, on our part, have been, doing our bit there. And I'm glad to see that the IIBX is finally seeing the fruit of all the effort of all the consortium partners and the IIBX management. And we have seen about 2.7 tons of gold transacted since inception. And most of that is in the previous month and the few days of October. On our part, domestically, we have, as in line with the Atmanirbhar Bharat vision or mission, in fact, we have actually added domestic refiners to the list of MCX good delivery refiners. And as Chandrasekharji was pointing out some time back in our discussions amongst the speakers, we must actually do something to stamp our authority globally. Of course, we are one of the most important consumption centers, and therefore, by introducing the MCX good delivery norms for BIS standard gold and silver refiners, we have actually set out to recognize the quality refiners in India, and we have put them at par within the LBMA contract. So the LBMA gold and the Indian refined gold, as per the MCX good delivery norms, it is at the same price, you see, and the industry has actually accepted this, and we have seen close to 7 tons of Indian refined gold, which has been delivered by the MCX platform. So these are some of the recent, important developments. And in fact, now, since the focus here is about fundamentals and retail, I have pieced together a few slides, which I will like to display. Is it visible, please?
Yes, now, yes.
Great. So as we're all aware, MCX commenced operations in 2003, and with effect from 28 September 2015, we are actually regulated as per the SCRA, and SEBI is the regulator. The exchange offers online trading and clearing and settlement, commodity futures as well as options, and with an inbuilt delivery mechanism. Of course, this makes it not just a platform for price discovery or trade, it also makes it an important platform for price risk management, where we have the leading jewelers of the country, small, medium, large, and the leading bullion traders and refiners who offset their physical industry risk via MCX. An important aspect here when we talk about risk management is that the composition of the price is such that it covers the international gold prices, the USD INR, as well as the custom duty tariff, which enables it to become a perfect hedge, covering all the volatile elements that there are. Therefore, from importers to traders to refiners to jewelers, all of them use the MCX prices, and most of the pricing we do understand is done in MCX plus minus fashion. It is a highly correlated price with international prices as well as with domestic prices, over 99%. And India's geographical location makes it very interesting, as we are able to see the beginning, the morning starting with TOCOM, then China, then London, and then the electronic markets of CME, all within one working day of India, of MCX. Now, talking about the product offerings, which again we try to cater to the demands of the retail investors as well as the hedgers, both. So we have a product in each denomination really. So an investor can actually invest in or trade in a kilobar of gold, 100-gram gold mini contract, an 8-gram coin, which is the gold guinea. And we were the first exchange in the world to offer a gold petal 1-gram deliverable contract. So these are the products from the gold portfolio. On the silver side, we have the 30 kg bar, and then 2 contracts, 5 kg and 1 kg, which have the 1 kg bar as the delivery unit. So all of these contracts that you see here, they're all compulsory delivery contracts. They can be used by retail investors as well to accumulate electronically as in an SIP, and to hold that electronically, accumulate it, and take the delivery physically out as and when they so desire. And the exchange has a vaulting mechanism across the country. And the liquidity of the order books ensures that the price locking in and the weighted average price locking in, if they choose, for the retailers is of a very efficient nature and a transparent nature. As they say, liquidity begets liquidity. So that is the advantage which an investor gains from an exchange platform vis-a-vis, a slightly less transparent platform, which could be there as you go across to a jeweler at the corner. So transparency, liquidity, enablement of systematic investment, holding electronically, all these things contribute to a vibrant platform. And on the option side, we introduced the gold 1 kg options in 2017. We have 2 option products in gold now and 2 in silver. Gold mini as well, that is 100 grams, silver 30 kg and 5 kg. And here I might like to add, although I have not covered volumes, you see, but the important thing to note is that, the options as a product has gained tremendous traction this financial year to date, vis-a-vis the previous year. And what we find is that the volumes of options have gone from around 1,100 crores in gold to around 5,000 crores. And in the case of silver, they're at around 2,500 crores from what they used to be around 250 crores. And this in a span of, this year to date versus last year to date. So in a few years, we are seeing that options, especially ahead of events like these, which we are saying, which are playing out, we see a lot of volumes happening in options, which means that people are understanding this more as an asset class, how to hedge themselves against volatility, while they may use futures as an offset hedge or long hedge anyway, but they further cover their positions with options. And that is a very healthy trend which we feel is emerging for retail as well as for physical investors. Now coming to just a snapshot of the volatility which has been there in gold. You've seen that this year, for example, 10.84% to date, which means that roughly 1,000 crore business would be exposed, to a price risk of 10%. So which would be around 100 crores, not 10, 100 crores. If they do nothing about, if they do not use any hedge mechanism, which is a serious thing. And if you look at that at a country level, and even if we assume 1,000 tons worth of gold is imported by India, then you can well imagine the numbers mentioned on the screen, that kind of a risk exists unless something is done. And when I say hedging, I am talking about the 3 elements, including the custom duty tariff, which actually changes twice a month. So therefore, the MCX prices take care of all the 3 things: currency, custom duty, as well as the international gold prices. The same applies to silver. Of course, you can see double the volatility at around 20% there. And you can well imagine what kind of risk the silver industry would be exposed to. So what do they do about this type of price risk is that they take a mitigating position via derivatives, which may be either counter to the physical industry, or it may be timed in such a manner that the physical industry transaction gets covered. So it could be a long hedge wherein you actually are offering, let's say, a long dated quote to somebody and electronically assuming a price position, whereas the physical purchase can happen later against that order, or a short hedge, which is an offsetting position, wherein a bullion trader imports via a bank and immediately takes a sell position on the commodity exchange and reverts that when he does the physical transaction later of sell. So as an example, I mean, if somebody is, let's say a 1 kg gold ornament is to be manufactured and the price gets fixed at 60,000, the spot is sold therefore at 60,000. The jeweler would buy futures at that time simultaneously, and then later on when he purchases gold against that order, whatever the price may be, the futures would also have either gone up or down accordingly, as you can see in the two scenarios. And the net result is no profit, no loss. This is what futures can achieve for you. Similarly, this is for the unfixed price, wherein he purchases the gold first, although he doesn't have the order. So he's fixing his spot, whereas the order is unfixed. He sells futures and reverses the transaction later. So this again results in a no profit, no loss scenario. This is how you hedge via futures. Via options, it is slightly more dynamic. You can actually profit from one side while ensuring that there is no loss by payment of a certain premium, let's say to the point of, to the quantum of 1% or so, like a medical insurance or a life insurance cover. And you're protected. You have a right, but not the obligation, you see. What people do different via options over and above a hedging via futures, these are the few things, just to give you an example. You see, what happens is that gold producers or miners may sell above the money calls at premiums and then buy protective puts with the same premium, which can create a floor price. So you're hedged in both directions at relatively zero cost, so which is called as a costless collar. And this is often used when you have a certain inventory or an anticipated production to take care of. When you talk about jewelers, this flexible pricing schemes during Akshaya Tritiya and during Diwali, in the current season, in fact, wherein jewelers are able to offer to their walk-in customers the lowest price of a particular time window, that is between today and, let's say, Diwali. This has been achieved via the put options that we have. And this is actively being done by a few of the large listed jewelers I can share with you without taking the names, and to good effect, because the liquidity in options has really taken shape. Now, looking at the inventory hedging, so you just monetize your idle stock by way of writing calls above the money when the implied volatility is higher. Because when the volatility is higher, so is the premium. So at that point in time, it makes sense to hedge via writing calls for the physical traders. So volatility, what they say, is basically a function of the price movement. What it means is it is the standard deviation of daily returns, which can be expressed in annual terms. And it measures the uncertainty or the degree of fluctuation of an asset. And high implied volatility always causes option premiums to increase, sometimes dramatically. And lower volatility means that premiums are lower, so you can actually hedge via buying options. So time to time, the strategy may differ, but this is just a sketch before you. And I must say that the Indian physical industry has more than graduated to this degree over the past 5 or 6 years that options have existed in India in commodities. I think there is what they say, that it comes naturally to Indians, this whole, we often hear that even during the times that there were no formal options, in Zaveri Bazaar, etc., used to hear terms like jhota, etc., when people used to, in unorganized ways also, participate in options. So that's as far as the futures, the options, the hedging, the retail asset class, and what denomination of products we have is concerned. Now, just one slide to tell you that it's very convenient to take physical delivery or to hold physical delivery in MCX. Just you have to open an account through your broker. You get a Comrisk, which is our warehouse receipt management electronic software. You get the credit after deposit of physical goods in electronic form. You can take a position, and when that position goes into settlement via the Comrisk credit, later on it can be rematerialized, and then the invoicing happens. And all this is done very rapidly electronically. A sketch of the total deliveries that have taken place at MCX: more than 137 tons of gold and 4,600 tons of silver have been delivered. While delivery is not a single most important aspect of a commodity derivative exchange, but in India, since we are actually looking at a futures, which is also till now, which has been catering to the spot demand at the end of the month, whereas now we have the EGR, which has come up. But then this delivery, what it does show is acceptance of price by both the buyer as well as the seller, and a thumbs up to the system in place, the process in place. So you can say, apart from that, the 1 gram gold futures contract itself has seen more than 89,000 coins delivered, and which is another retail product, which is the silver 1 kg and 5 kg contract, wherein the 1 kilo bar of silver has seen close to 250,000 kilobars being delivered ever since we introduced this change somewhere in 2020, which means around 250 tons of silver in pure retail demand. So this is where we would like to continue doing our bit, since this forum is more about retail, to offer these products to the retail, organized products, quality assured products, exchange backed, good delivery, and the ease and the convenience of holding accumulation and systematic investment. And of course, the liquid order books that we are having at play. I'll just like to end by saying that, while we all have been aware, and we have Mr. Surendra Mehta, who's a leading CA in this forum, the Section 43/5 of the Income Tax Act actually allows the offset of this income as business income, what you actually gain by futures or options, against your physical profit or loss if you're a bullion trader or jeweler or from the industry. So these are some of the important things to actually note. And I once again thank the chambers for giving us this opportunity once again to directly interact with so many of you. And I thank my panelists and Mr. Chandrasekhar once again. Thank you.
Thank you. Thank you, Shivanshu, for this very lucid presentation. I think you took our discussion to a slightly higher level than usual. So it's very, very interesting. You have talked about the products that are on offer. You made a strong case for why people should come to MCX to hedge their price risk, etc. Thank you very much. I'm not sure if I should let you go right away, or please stay back until whatever time is possible.
Sure.
It'll be interesting. Already some questions have started to come in, but I'm now going to invite our friend Surendra Bhai Mehta, President of the IBJA, Indian Bullion and Jewelry Association. He's the face of the industry. He's the voice of the industry. And it'll be very interesting for all of us to hear Surendra Bhai's views. So over to you. Over to you, Surendra Bhai. Unmute. Please unmute yourself.
Yeah, thank you, Chandrasekhar ji. You started with the superb opening remarks and followed by Shivanshu, who explained, I think, A to Z of the commodity market, commodity derivative market, including future and option. And I think one need not now get into details of this commodity market. What I would like to cover is that about 10 years back, the entire bullion market, the entire gold market was looked at with some red eye, or
Great
the
suspicion.
entire market was looked as a market of suspicion. But I think now the gold ecosystem are in place. As Chandrasekhar ji, you know, and my other eminent panelists also know that we at IPJA had tried to bring the entire gold ecosystem onto a platform wherein there is more transparency to the entire system. The people are not cheated even for buying the jewelry. We have brought hallmarking system in the country, and let me tell you, this is the unique system. Even now, countries like European countries have started, understanding that how can an country like India hallmark 1 crore pieces, 1 crore jewelry pieces every month. It has been almost 2 years since we started hallmarking, and I think we have already hallmarked close to about 30 crore pieces, which is remarkable journey as far as jewelry is concerned. And I think the people are happy. Still, out of about 750 odd district in this country, only 343 districts are covered for the mandatory hallmarking. But let me tell you, there is no reason to fear. About 93% of the jewelry which is sold in this country is already hallmark, whether you buy it from hallmark district or non-hallmark district. So most of the district where this manufacturing is done is already hallmark, because the hallmarking has been made at the first point of sale and not at the last point of sale. This was just about to make our consumer understand that buying jewelry now is as good as buying a gold or a bullion. The only thing is that you pay a little extra in terms of labor charges, and but by paying labor charges you can flaunt with the jewelry. So I don't see, and normally your family is very happy when you buy jewelry, but they are not happy when you buy a demat products like like sovereign gold bond, where it is kept only in the electronic format.
The
But
ladies
anyway,
can't wear. Ladies can't wear a
ladies
certificate.
cannot wear those things. But I think this commodity exchange like MCX has a very good platform. Shivanshu ji very nicely explained that there is a 1 gram gold contract where delivery is possible. There is an 8 gram contract where also delivery is possible. So I think I always suggest everyone that if you are planning to buy jewelry only when it is required. Otherwise, you keep investing in bullion and convert that bullion into a jewelry. What happens? Suppose you want to have a jewelry after 2 years or 3 years for some celebration or for some wedding or some festival. What happens? If you buy jewelry today, it will become old fashioned after 2 or 3 years, because there is so much of innovation happening in the jewelry market. So today you have very good Calcutta jewelry in fashion. Tomorrow you can have Italian jewelry in fashion. Day after tomorrow you can have electroforming jewelry in fashion. So you don't know what other products will come. And this industry has been doing excellent work as far as these designings are concerned. So I always suggest that please go in for SIP kind of an investment where you keep buying bullion, either through a commodity exchange or through any other mechanism. There are various methods available in the country, and that convert that bullion into a jewelry by paying the labor charges only. So that is what I wanted to explain to everybody. People keep asking me this question: what is a good time to buy gold? I always say every time is a good time to buy a gold, provided you have a vision for about 8 to 10 years. You see, when you buy the bullion, you should always look at bullion is not a product which is dependent on the a promoter of a company or a promoter of a country, but it is dependent on the economics of the country. And it does not depend only on the economics of your country. It also depends on the entire world ecosystem, on the entire world politics. So there are geopolitical tension involved, there are trade barriers involved, there are inflation involved, there is bond yield involved, there is a demand supply involvement, how the other asset class are performing. That That is also. So there are many factors. I may give importance to a bond yield as one of the most prominent factor, and my colleague Chandrasekhar ji can give can say no, dollar index is an important factor. So our views might differ, but eventually that is why I always say that please look at the gold investment as an option when you have a long-term vision. Otherwise, it will remain a consumable commodity for you. If you are trying to invest, please invest it for 8 to 10 years. And since you don't know what will happen in future, always look at history. So if you look at history, what was the price? I tell you, like in 2015, the gold prices were about 2,684 rupees in November 2015. But in November 2023, we are almost in October 2023, the gold prices are 5,959,000. So from 2,684 to 5,970. So you already have about 120% increment in the 120 to 130% increment in your investment. So what else you want? In 18 years, you get 120% return. So which is almost 15% return per year. So I think always look at the history of the gold. Do not try to look at the future. Do not try to look at what will happen, whether Israel will continue or not. I don't know whether it will continue or not. If you ask me today, all the analysts look at the chart, but will chart work during this time? Did the chart work during COVID time? No, it did not work. The chart will not work during. It did not work during Russia-Ukraine war. It did not work during, and it will not work during this Israel and Hamas war. So I think we should not look at future of the gold. We should always look at the past performance of the gold and then think of buying the gold. As far as price setting of gold concerned, I slightly differ from my senior panelist Chandrasekhar ji, and I'm sorry Chandrasekhar ji for this.
Perfect.
Because I always feel that I personally feel, being an Indian, that yes, we should become the price setter. But I think for setting up the price of the gold, there has to be a two-way transaction.
Yes.
And India is a net importer of gold. We are importing gold 99%. And for this purpose only, we have requested government that you allow us to export gold also.
Yes.
We already have 30,000 tons of gold stored in our country in household. We have about 2,000, 3,000 tons of gold in temples and other religious trusts. So through this IIBX channel, India International Bullion Exchange, which is established at Gift City, we want this gold to be exported. And we want all this, as Shivanshu said, Atmanirbhar Bharat. But we can produce this gold as an Atmanirbhar Bharat. We can make the gold bars, which is compliant with the OECD guidelines, because there are refineries which are compliant to OECD guidelines. We want to export this gold. Let me tell you, IBJA is also setting up a bullion refinery in Gift City, where we would like to, we would like to refine such golds and then export it to foreign country. So I think the government is already aware about this situation. And Chandrasekhar ji, aapke muh mein ghee shakkar, very soon we will be able to set the price, or at least we will be in the commanding position to set the price. And I think to set up the price, whatever is needed, the two-way transaction, very important thing.
Yes,
if you want to set up any price, we should have a two-way transaction. Today, IIBX only allows import of gold. We want IIBX to allow export of gold also. Once we start exporting gold, we will command a position in the international market as far as gold is concerned. The other important aspect about gold, what Shivanshu gave, is the commodity exchange platform, which are real platform for price discovery and price risk management. I would not like to get into details of this price risk management, but let me make you one thing very understand, that there are advantages of trading on the commodity platform. Now, what is that advantage? These platforms are very transparent. That is number one. Number two, you are dealing with the regulated entities. Number three, you are assured of your quality of the product. You are assured of purity of the product. If there is any dispute, you have a right to complain. You can complain to the regulator. You can complain to the exchanges. Then your payment is guaranteed. Your delivery is guaranteed, and there are no tax compliance issue. Whatever you get from the exchange, whatever you purchase through the exchange, or whatever you dispose of or sell off in the exchange, it's all GST compliant. So I think these commodity exchanges are the great platform, but there is a long way to go. I was just reading yesterday that out of total only 3% of the total population of India invest in equity market. So I think Chandrasekhar ji, if I'm not mistaken, for commodity market, this won't be even 0.3%.
Right, that's
We
right.
have a long way to go.
Absolutely.
Commodity market, I recently heard that one of the very big commodity broking house in our country has set up a very big, is in the process of setting up a very big commodity desk platform. And they all feel that this market is going to grow and there will be ample commodity available on the exchange. And since we are talking about bullion as it is always a leading product. I personally feel that we should look at the bullion as the part of our portfolio. We should look at, I always suggest, being a Marwadi and a Rajasthani, I have a lot of passion for gold, but not a passion like what women in this country have. There is a saying in Hindi, जब तक नारी है तब तक सुनारी है. तो जब तक नारी है तो जहां तक औरतें हैं वहां तक सुनार लोग तो जिंदा ही रहने वाले. तो I feel that make your family happy. Keep buying gold. Keep at least 8 to 15% of your portfolio investment in the gold out of all the equity. This is the best investment against all other asset class. Don't try to understand what is hedging and all. I think you should only look at pure investment, that we are investing based on the past performance of the commodity. I never advise anybody कि ऐसा hedge कर लो, do this and do that. That is only for the jewelers to do. For a common Indian public, I just say please keep 8 to 15% of your portfolio in the gold. I think I've said enough because Shivanshu has already clarified a lot of things about the commodity exchange. If anything I'm missing, Chandrasekhar ji, you can ask me again. Thank you so much.
No, thank you very much, Surendra Bhai. Absolute clarity of thought and clarity of expression. There are just three things I want to mention. One, as far as price setting is concerned, you and I are actually on the same page. Even as 8 or 10 years ago, I have commented on the need for India to open up gold export because gold import window is open. Why keep the export window closed? And I've always believed a free trade must happen. But anyway, so I think we will probably be moving in that direction. Number two, you made a very simple yet absolutely telling guidance that you gave to the viewers, to the participants, saying that that you must have a time horizon for use of the metal that you invest in. Don't buy jewelry, buy actually the metal, bullion. And when there is an occasion, marriage or anniversary or whatever else, convert that into jewelry because the fashion is changing very rapidly. I think it's a very simple yet telling guidance that you've given. The third one is about awareness and education and training. For at least 20 years, I've been doing this awareness and training about commodity markets. I'm completely with you. Most of my presentations talk about how India's economic growth over the next 25 to 30 years is going to be driven by commodity markets, whether it's agriculture commodities, metals, energy products, all these are going to play a big role. So commodity markets are going to boom in India. In the US, commodity markets are bigger than even the equities market. And we have to move in the direction, but exchanges, the regulator, market participants, trade associations have a huge responsibility to take this message to all the value chain participants and to all the investors and particularly retail investors. That's a huge task, which I continue to do in my own small little way. Therefore, thank you very much. It was wonderful. Yes, I think Surendra Bhai has something to say. Please join. Yeah.
I just wanted to add one more thing.
Yeah, please.
I have been telling all the commodity exchange that these options are not performing as good as they are performing in equity market. The major reason for option not performing as good as like in equity market is the cost of the option. The options are very expensive. In commodity, you cannot have option with 6% interest or 5% interest. They are very expensive. It is not an equity. So I think one needs to look at it, and one needs to talk to regulators probably what can be done. I think MCX is coming out with the instead of 2 months, they may come out with 1 month expiry option contract. I think that would be a wonderful wonderful thing. But still, I feel that options are expensive. Thank you, sir.
Perfect point, well taken. We'll also try and take it up with the regulator. I'm now going to invite our friend Vikram Dhawan, his hands-on experience. I'm sure Vikram is going to give us his nuggets of wisdom and knowledge about the bullion market. Vikram, the floor is yours.
Okay, thank you very much, sir. And thank you very much, Shivanshu, and thank you very much, Mehta ji, and all of you, and especially big thanks to IMC MCX for inviting me for this show. I think everything has been said, so actually I should be doing the valedictory address and just giving it away. But anyway, I'll try to put in my 2 cents of, wisdom, as Chandrasekhar ji said. See, India has a love-hate relationship with gold, as Mr. Mehta mentioned, that even now, whilst the sights of the establishment and the regulators are less, less abrasive, I should say, than what they have been. But again, I think there is a bit of suspicion which always remains, and that is why we have such high duties on gold. There is a GST also, which is for a valuable commodity like gold is pretty high, and a lot of other things, a lot of regulations, and I think it's a very, probably we are one of the most over-regulated market in the world as far as bullion is concerned. So that is the hate part of it. The love part of it is that one of the reasons why India and Indians weather any economic crisis better than their peers overseas is because we have one of the highest holdings of gold. I think rough estimate, it could be anywhere between $1.5 to $2 trillion worth of gold. So you can imagine that whenever there is an economic crisis, the prices of gold go up, and that creates a very strong buffer for Indian households across the spectrum, across the whatever salaried or business as the case may be. And we saw it in COVID that obviously a lot of these gold loan companies became very busy, but they became busy because there was a lot of gold to be given and for in exchange of money. And that's the reason that we buy gold, because it comes in handy on a rainy day. So I think very quickly I'll just come across, I'll try to put across a few points that why we need to gold. And I mean, I'm sure you are aware of most of them, but maybe you can say a quick revision on why we need to think about gold, why we need to hold gold in our portfolio. Obviously, what Mr. Mehta said, that gold jewelry obviously makes your family and your better halves happy. So that is one reason. But besides that, gold has, well, gold has been one of the best, sort of retainers of value, a good store of value across various asset classes. Just to give you an example, the a gold bar the size of a mobile phone will be roughly about 2 kilos, which is more than a crore, 1.5, 1.2 crores. And if you try to stack any currency notes along with it, whether it is Indian currency or US currency, you'll see that the sheer volume these currency notes occupy is a lot more than the physical gold. So as you can see, and if you go 50 years back, the same bar could have been exchanged for a lot less currency notes. So as you can see, the supply of money has increased to a very large extent, whereas the supply of gold remains limited or finite. And fortunately, the central banks have not figured out a way to print gold. Till that time, this store of value attribute will continue for gold, and which is also in a way indirectly hedging inflation, because the more the money supply is, this means more money is chasing the finite amount of goods, which means there is some sort of an inflation which may not or may not show on in WPI or CPI. But fact of the matter is that if you talk to any old timer, they will always tell you that this thing used to cost 1/10 or 1/100th of what it is costing now. So it is nothing. And gold has been able to keep pace with that kind of inflation. So it's not just quarterly or YOY CPI, WPI, but if you see inflation across decades and centuries, you will realize the value of gold. The US dollar, which is the main adversary of gold. I mean, in the 1971, I think President Nixon of US stamped out the gold standard, wherein until that time, every currency had to be backed by some hard asset, and gold was the prime hard asset, which was a backstop for all the currencies. After that, sort of gold, the delinking of the currencies with the gold resulted in gold being less important, or in the banking sector, in the financial sector. It had a cycle wherein it became irrelevant. In fact, if you have been following the gold market for past 20, 25, 30 years, then in the mid 90s or just before the Asian crisis, gold had gone to as low as $250 per ounce, and it could have gone down lower if the Washington Agreement would have not come in place, wherein they restricted banks and institutions and countries to sell their bullion in the market. And see where we are right now. It's just the other way around. Instead of selling, the central banks are the largest buyers of gold. I mean, last year they bought 1,300 tons of gold, which is a 55-year high, and this year already they have bought 400 tons, which is again a 25-year high for an H1. So and again, dollar. Well, these things, we are in a trend where de-dollarization is picking up strength for various strategic, geopolitical, and every incident or a war like Ukraine or what we saw in Israel will further divide the world, and there will be need for alternatives to dollar. And dollar itself has not done too much of glory, not covered itself in too much of glory, because today the national debt of US is roughly about $30 trillion, which is almost 10 times the size of India, and it is close to about 100% of GDP, and it is expected to go to 120, 110% of the GDP if there is a recession, because then again the US Federal Reserve will have to print more money, and the debt will increase. Already Mr. Biden wants to write off the student debt, which is close to $1 trillion. So it is not a sound currency, dollar, but it is the least worst currency, as they say, if you compare to other currencies. And that's why sometimes you don't have to be the most prettiest or the smartest or the cleverest person in the room. You need to be the least dumb or the least the least qualified, the least worst person in the room to get everybody's attention. So that's where we are as far as dollar is concerned. And interestingly, if you would have read the news flow post-COVID, and even recently when the debt to GDP ratio of US jumped significantly, there were agencies which were willing to consider further downgrading of the US. So in a way, whether it is dollar or rupee or yuan or yen, it comes with a credit risk, it comes with a country risk, whereas gold doesn't have any country or credit risk. It so the gold is not only a protection against long-term inflation, it is also protection against long-term deflation. Because during the deflationary environment, we see collapse in house prices, equity prices, and risk assets. And when that happens, then there is affinity towards safe havens, as we have seen in every crash. Whenever there's an equity market crash or a housing crash in 2008, equity crash during the COVID and where 2008 and 7 crisis, gold has people have always switched on to something which is more tangible and more, which has more intrinsic value. Geopolitical uncertainty, I don't need to tell you much about it, what we have seen in the past few days. But I think it is worth noting and reiterating that with every geopolitical, event happening, and we had Ukraine some time back, on Israel, and then could be Taiwan. Who knows? I mean, these kind of issues will further divide the world in terms of trade, in terms of flow of capital on current accounts, which may lead to a lot of volatility in the currency markets. Because just to give you an example, today India has been doing bilateral trade with countries like Russia and China in their own currencies. But the result is that today Russia is saddled with hundreds of billions of dollars of rupee. Similarly, China also had so much of billions of dollars of rupee, and same is going to happen with Middle East also. But remember, all these currencies, whether it is yuan, whether it is ruble or rupee or the Middle Eastern currencies, they are not, well, Middle Eastern currencies are, you can say, theoretically fully convertible, but the rest of these three currencies are not fully convertible, which means there is no international bona fide spot market. So tomorrow, if you have $100 billion worth of yuan and you want to sell it in the international market, there is nobody who's going to buy it except the Chinese central bank. So these things, if these imbalances become too big, you could see a lot of volatility in the currency market. And as we have seen that whenever currencies are volatile, it sort of is good news for gold. I mean, whenever rupee falls, whenever ruble falls or yuan falls, I mean, you look at the data of past week or couple of weeks back, where whilst the dollar price of gold was languishing around 1900, but in terms of yuan and yen and ruble, the gold prices were either at all-time high or close to their all-time high. So I think when we talk about gold, it's very well, you should know where the dollar price is, but for us, the Karm Bhumi and the Dharm Bhumi is India. So I think it's very important to see the realized price, which is in rupees terms. And I think any amount of currency volatility gold is one of the very few assets which will protect you and hedge you against currency volatility. Now, supply constraints and increasing demand. Supply constraint, obviously, yes, as the gold prices start going higher, there will be more mines coming online. And but at the same time, today the mining industry is in a bit of a mess and distress because of environmental reasons, what we call as the ESG, which will append a lot of greenfield projects. And the large mining companies are so much, hesitant to break ground for greenfield projects, because no CEO of a company or board of directors of a company would like to have this on their CV that during their term a mine had to be shut, or a mine project had to be shelved because of environmental reasons. So there's a lot of risks which are riding and which have increased because of the environmental and social and governance issues. And I think as we go ahead, and as environment becomes a very important aspect of good global dialogue. Just to give you an example, I mean, I don't have a slide. I wish I could show you, but the coverage of ice in Antarctica. Antarctica is the lower part of the Earth. The coverage of ice in Antarctica has reached a terminal point, which means no matter what happens, we will never have the ice coverage of Antarctica increasing. It can only decrease from here, and we don't know what's going to be the effect of it. So the bottom line is that whether it probably the climate change, the effect of climate change has not come to your doorstep or my doorstep, but it has come to various doorsteps, and that is why it's no longer easy to get environmental clearances for large mines which will be digging. If you go to South Africa, there are some mines which are as deep as 4 kilometers. So the environmental cost of such mines. So that's why I think gold prices need to be much, much higher from here for very large greenfield capacity to come in. And in terms of demand, today at $3.5 trillion GDP size, we consume about 800 to 1,000 tons. And if we are going to be a $5-6 trillion economy in the next 10 years, I'm not saying this will become 2,000 tons, but it will surely become 1,200 to 500 tons of 1,500 tons of gold. And not that much of capacity is not planned online. And this is just one country. We're not even talking about China. And China and India put together by roughly about 50%, account for roughly about 50% of the physical demand. Now, portfolio diversification. Gold, there are 2-3 reasons why people should consider gold for portfolio diversification. First of all, whenever there are large moves or whenever there is very high volatility in the risk assets like equity, that's a time when gold performs its best. Its attribute of a hedge kicks in. Kicks in as when in fact, there was a study done by World Gold Council which says that if the risk assets move down in multiples of 1, 2, 3 standard deviation, then that's a time when gold actually performs the best. Also, in times of recession, gold has been the best performing commodity in the past 50 years, which means that, if you have a portfolio of debt and equity, and if you want to diversify your portfolio away from debt and equity, then, gold sort of ticks all the boxes. Now, where we are on this Nippon India Mutual Fund, with with your patronage and with also support from the IBJA, Mr. Mehta, we're very grateful to you for being the market leader in both gold and silver. The kind of support we get from IBJA and also the organizations like IMC, we are the market leader as far as gold and silver ETF are concerned. But I think that is the numbers, more than the numbers. It's my personal opinion, and it's been echoed by a lot of commentators in this space, that gold and silver ETFs are probably one of the best inventions of the financial sector in this century. Why? Because you have a product of gold wherein you can buy very small quantities. I mean, the unit size of our gold ETF will be roughly about 50 rupees. So you can buy multiple of those units from National Stock Exchange, or you can come directly to the fund house. And not only us, there are other fund houses also you can go to. Almost all the top fund houses have got ETFs, gold ETFs and silver ETFs and gold funds. So you can go to any one of them. But the good point is that the liquidity of these gold ETF units is significantly more superior than the physical market. So it has been a very big boon for the retail investors specifically, because they can trade in small quantities with very low impact cost. And it is also, if you're coming directly to the fund house, then you don't even need a demat account, or you don't even need to have a trading account with a broker to invest into it. But I think the moot point over here is that if you believe in wealth creation through capital markets, then I think you would need to have a diversified portfolio. Why? And then this is something which I will take a pause over here after saying this. I think I've spoken a lot. Is that, when you have a multi-asset portfolio, it does a few things for you. if you have debt, equity, and gold in your portfolio, then you are not only positioning yourself to participate in the long-term trajectory of all these asset classes, because equity will have a long-term return, debt will have a long-term return, gold will have a long-term return. If you have that in your portfolio, you will participate in the long-term trajectory and price, action of all these three asset classes. But at the same time, since all these asset classes more often than not are either poorly correlated or negatively correlated, the volatility of your portfolio will be significantly lower than the overall market. And why you need a lower volatility portfolio? Because the secret to wealth creation, as you must have heard from various gurus, is that investment guru, financial gurus, is that the secret of wealth creation on a larger scale is compounding, and compounding happens more steadily and more certainly when the portfolio volatility is low. I mean, there's no point having a portfolio which is up by 20% one year and down by 30% next year. Then no compounding will happen. So you have a diversified portfolio, and wherein you are able to participate in the long term story of the asset classes with a lower volatility. So I think that is where gold ticks all the boxes. And I think one last thing I would like to say, that there is no age, there is no net worth which is needed to invest in gold. Even if you are a young person who has yet to buy a house or hard assets and you don't know what to buy, you can probably buy gold in digital form, or gold ETFs, or a gold bar, or whatever it is. Because if inflation rises and the prices of hard assets or price of your house will go, which you want to buy, goes up, then you'll have at least some hard asset in your portfolio. So yeah, so a lot of things to talk about, but I'll take a pause over here, and if there are any questions, I'll be very happy to answer. Thanks.
Thank you, Vikram. As always, absolute clarity of thought and expression. You took us through the drivers of the market and how they can pan out, and how over time gold has always been a safe bet for investors, and great hedge against inflation, etc. I think perfect. I think point very well taken. It's about 5:20. We are actually coming close to concluding, but let me take Surendra bhai, any point, any additional comment you have before I take up the questions? Any additional comment that you have?
No, sir.
Right. So let's have a look at. I think I find these are not questions really. These are comments made by people. How can I start my own trading? What is the minimum investment and other criteria? I don't think we should discuss this in this forum, but I'll request what's his name, Deepak Tiwari, to get in touch with. I'm sure Vikram will be able to help. Vikram, maybe if it's okay with you, you can post your email ID in the chat box. People can connect with you, or I don't know, Surendra bhai would be able to help this person. He wants to start his own trading, etc. So if you can post your email ID, this delegate can contact you. Next is trading on gold or ETF bond, which is more beneficial. Any thoughts, Vikram?
Trading in gold and trading in bonds.
Bond, yeah.
Yeah. So see, again, one of the reasons why we buy gold is because of liquidity. And the most liquid form of gold is gold ETFs. Then you have gold bars.
Yeah.
Then you have jewelry. Gold bonds, unfortunately, very good product, but they are not. Liquidity is very poor. And I mean, the thing is that you need gold. I mean, today, it's not a good example, but if you were stuck in somewhere in the crossfire of Israel and Hamas, and the only liquid thing that you would have is the gold bar in your because there's no electricity, so you can't make even any transactions. So last thing you want is that the kind of gold you are holding is is down. There's so much of impact cost of 20%, 30%. So you want your gold to be in a liquid form. So yes, if you are looking for a very, very long-term investment, you don't want to touch that gold for 5 to 8 years, then maybe gold bond could be a good bet. But if you're using gold for liquidity, for insurance, for hedge, for portfolio diversification, then you need a more liquid form of gold, which is gold ETF or maybe bars.
Yeah, I think I hope that clarifies Vinay's question. Yes, of course, Surendra bhai, please.
One piece of advice to all the investor:
Yeah,
always invest in gold. Do not invest in any other form of uh, any other commodity. Why? Because gold is the only commodity against which bank loans are given.
I love
If
it.
you buy any other precious stone or any other metal,
Correct.
no bank loan is given.
A very, very critical point.
Yeah.
Very important.
Well said.
I love this. Very well said. Trading in gold. Okay. Is gold a good bet as geopolitical uncertainty is increasing? I'm sure speaker after speaker has said, yes, you must invest in gold and it will be a good bet. Not just because of geopolitical uncertainty. There are several other drivers of the market. Okay. Was Ukraine war the exception of gold being looked at as a safe haven in times of crisis like war, because Russia holds huge gold reserves, that efforts are made to intentionally keep gold prices low? I'm not sure whether we should get into responding to this question, unless Vikram or Surendra bhai, you have any response to this.
I think the only thing I would like to add is
Yeah.
that gold has been around for thousands of years. So
Yeah.
a few quarters here and there should not be viewed as a long-term trend.
Exactly.
So take a long-term view.
Exactly. Yeah. Next is Mandar. Futures and options contract volumes of gold seem to be very low on MCX compared to global market, especially. Are any special effort being made to improve these trading volumes? Anyone from MCX in place of Shivanshu who would like to respond? Okay. Overall,
I can, if you want, I can give
yeah,
a small rejoinder.
please, sure, please.
So I think one of the reasons why the volumes in overseas exchanges are multiple times of the Indian exchanges, in commodity exchanges, is because there is no restriction on the participation of banks and mutual funds.
Correct.
Whereas in India, we have banks are not permitted.
Correct.
Mutual funds are also permitted, but with a lot of restriction. But I think we understand, and I'm very hopeful till Chandrasekhar sir is in CDAC that something will happen, and the floodgates will open in the
Yes.
not too distant future.
Yeah. I think it has been it's a part of my recommendation as far as the roadmap for commodity derivatives is concerned. So we need to check. We'll see some action, I'm sure. Overall, but also I'm on record saying the commodity exchanges have a huge, not only economic duty, but a moral responsibility to work towards increasing volumes and attracting more and more retail participants. As Surendra bhai mentioned, if I recall correctly, 3% of the population trades equities and probably 0.3% trades commodity derivatives, because even 20 years later, all these exchanges started 2002, 2003, and I've been associated with each one of them for these 20 years. I have myself done several hundred programs in the last 20 years. But yet, I think we need it has to be a continuous effort to create awareness, educate, and train market participants. I think there the impact that the exchanges have created in the commodity ecosystem is, in my view, weak. I'm not talking about any particular exchange because I work with all the exchanges. They do a lot of events, but there is no impact assessment and there is not much of follow-up. But anyway, the exchanges have to rise to the occasion and do a lot more of these awareness programs, which will have an impact. It is not that an exchange goes to 40 or 50 people who gather and say, yeah, I have a futures contract. Will you start trading? And this will help you hedge your price risk. That's no way. That's very poor communication. I think you need to generate interest in the minds of the market participants to actually start looking at the product that the exchanges have on offer, and then start to experiment. I think that I think our communication strategy has to be very different from what it has been in the last 20 years. Anyway, those are my private views. Zoom user, CACS, Lalit Agarwal. India should think and methodically set up a spot exchange. I think, yes, that is his view. Any thoughts on this, Surendra Bhai? Can we have one nation, one price, which is the main goal of the government?
No, we will very shortly, we will have the spot exchange.
Yes.
So
yes.
one nation, one price, the logistic cost
Yes,
logistic cost will always add. It
Bilkul,
adds in a
bilkul.
country like China also.
Correct,
So
correct.
that one nation, one price is only a glimmer. It
No,
cannot.
it will not work. Basmati rice grown in North India, it can't be sold at the same price in South
Price.
India.
Correct.
So I think it's okay. A coconut oil is produced only in Kerala or Tamil Nadu. You can't get the same thing in Delhi or Lucknow at the same price. So therefore, there are variations. But anyway, okay. But I think it's an ideal situation to have one nation, one market, one price. Ashutosh from Multi Act. We believe gold to be the best quality cash in the world to approach. Okay, I think he's expressed his views. There is no question, which is fine. I think we have now we have come to the end of, we want to conclude this webinar. I want to thank Surendra Bhai Mehta. I want to thank my friend Vikram Dhawan. I want to thank Shivanshu, of course, who's left. I'm sure we have covered a lot of ground in the last 90 minutes. Gold is a solid investment asset, which more often than not will not disappoint the investor, but he must have a long-term view and long-term vision for investment in gold, and there will be no regret. I think this is finally the message. I want to thank all the participants. I want to thank IMC Anita Naik. Anita, will you post your email ID so that anyone with any question can write to you, and we'll try and respond with the help of our panelists. And with this, let me say good luck. God bless you all. We'll conclude this event, and I'm sure with MCX, IMC will continue to do a lot of events. We did last month on energy products. This time it is bullion. Hopefully next month it could be base metals, and then of course it could be agriculture commodities. We will keep this kind of commodity market fundamental forum going forward in the next for a long time, in my view. Okay, thank you very much. Good luck. God bless you. Let us conclude this session. Thank you.
Thank you very much. Good evening, everyone.
Thank you.
Thank you, everyone.
Thank you, Anita.